Good morning and welcome to Stock Market Today. It's Tuesday, January 8th, 2019, and I am your host, Dan Russo, the Chief Market Strategist at Chaikin Analytics. You can find me on Twitter. I'm at Dan Russo _CMT. Stock Market Today brought to you today and every day by Chaikin Analytics. And if you head over to chaikinanalytics.com/today, you can sign up for a free email, give you stock ideas every day, and you'll be able to follow along with this show. Jumping right into the market commentary, U.S. equities were higher in Monday's trading, extending last week's gains as the NASDAQ and the Russell 2000 outperformed. Consumer discretionary and energy were the best performers, while utilities and consumer staples were the biggest laggards. Treasuries were weaker, with the curve flattening. The dollar was slightly better against the yen, but weaker on the other major crosses. Gold up 30 basis points. WTI crude settled up about 1.2%. So your outperformers, discretionary, energy, tech, REITs; underperformers, utilities, consumer staples, financials, and materials. And as we get to the desk this morning, S&P futures are up 80 basis points after finishing mostly higher on Monday. Asian markets were mixed overnight. Japan outperformed, but China did lag. European markets are seeing solid gains this morning. Treasuries are weaker, with some more curve flattening, and the dollar is flat versus the yen, but a bit firmer versus the euro. Excuse me. Gold down 40 basis points, and WTI adding another percent here this morning. As we dive right in, chart of the S&P 500. We've rallied into the resistance range is how I'm kind of defining what we're seeing here. To me, the rally is counter trend in nature. We do still have a series of lower lows and lower highs. The index is below the 200-day moving average. That is a definition of a downtrend. And on top of that, the RSI remains in bearish ranges while Chaikin money flow is still bearish. For me, this is a counter trend rally. There's a lot of overhead supply right here. I think that resistance in the 2580 area and then near 2600 to 2630 is likely where we're going to see some of this supply come out. I use the word likely. Support does remain down around the December lows for now. What we are looking for, as I've said, and if you've read our notes and followed along, what we're looking for is a less intense low. I think we could see some choppy, volatile trading here as the market probes the December lows. And what we want to see there are breadth and momentum divergences to give us an indication that the selling pressure is waning and that a durable base is forming. So for now, I think it's a great opportunity to use strength to sell some winners and build watch lists. Build your lists of names that have been outperforming as the market has gone sideways or as the market has declined, because those names have a higher probability of being your leaders when the durable base does form and the market does begin to move higher. So your market in a minute, if you're following along in that email at home, or if you have my note as a Chaikin Analytics client, stock stage of follow through to Friday. Strength, small caps lead, and defensives lag as portfolio position shifts in the new year. I think what's a little bit of what we're seeing here, some of the counter trend rallies that we're seeing is some position squaring amongst investors as we come into the January timeframe. Materials are a must watch as the dollar declines, and futures do point to a positive open here today. Stock of the day. As we, I'm sorry, you know what? Let's do the power bars. Chaikin power bars for the major indexes. I apologize for that. Dow still 0 bullish stocks, 8 bearish stocks. S&P 500 seeing a little bit of an improvement, 20 bulls to 136 bears. NASDAQ, an outperformer yesterday, 7 bulls to 27 bears. Small caps led the way, up 1.78%, 158 bulls, 474 bears. First time we've seen this number below 500 in a while, so that could be an encouraging sign. Bonds down, ticks in, yield slightly higher. Consumer discretionary, big outperformer on the day, up 2.25%, 5 bulls, 22 bears. What I would caution there, before reading too much into it, I always say dig in a little bit, see what's going on. Amazon has had a roughly 300-point rally off of its lows. Stock got down to about 1,300, trading now back near 1,600. Amazon is a big weight in the consumer discretionary sector, likely to have an outsized effect. If you dig in through the rest of the group, some improvement, but not as much as the recent trends would have you believe. Our stock of the day, auto-generated by our algorithm. VMware, very bullish stock, closed at $143.74 yesterday, up 3.5%. Nice outperformance. Chaikin Power Gauge rating on VMware is very bullish due to very strong price volume activity, attractive financial metrics, strong earnings performance. When we roll up the 20 factors that fall into these four categories, we come out with our very bullish rating. Strong trend, strong industry group. We're fishing in the right pond for long ideas. Right type of name. Ribbon at the bottom of the screen tells us where that power gauge rating is and has been. We can see we are on that very bullish rating. And the market and model are in agreement. Dynamic duo in gear as VMware has been outperforming the S&P 500 since roughly the mid-November timeframe. Nice breakout here to highs above the rising long-term trend line. My concerns are two from a tactical standpoint. First, we're overbought. Second, as we're making new highs, Chaikin money flow is bearish. What I'd like to see is a consolidation, maybe retest of the $140 level that holds, maybe even $135. Hold that mark, generate an oversold condition based on our indicator, and then look for an opportunity to enter. And what I will point out is the computer software and services group, especially the names that are tied to the enterprise and to the cloud, have really been showing some solid relative strength. So as tech is weakened, within tech, there are some bright spots. Enterprise software and cloud software are two of the areas that I would go looking for ideas. Look for the names that are holding up on a relative basis. Think CRM, think Adobe, think Microsoft, think VMware when you're building your bullish watch lists. Your sector tracker now, looking at movement over the last 5 days, can definitely see some of the counter trend trading that has been taking place as the new year gets underway. Energy rallying with the price of oil. That move looks counter trend to me. Comms, a little bit of a defensive posture there as the communications group is now split between the old stodgy comms companies. Think Verizon, think AT&T, and some of the newer names that have been added to the group. Think names like Facebook, think names like Google. Discretionary, as we said, seeing some strength due to Amazon rebounding from the lows. On the laggard side, it's those defensives that had been leading as the market was selling off, utilities, healthcare, and real estate, that have been lagging of late. I do think that these are early year counter trend moves. We have to wait and see if we're going to revert or if there's something more meaningful here. So far, I don't think it's meaningful, but as always, I will change my mind as soon as the facts change. Right now, I don't see a reason to do so, but as you know, I am watching this stuff every single day. Our industry in focus. Yesterday, we looked at oil and gas services. Today, we'll look at E&P, another group that we have been uber bearish on, which over the past 6 months has underperformed the S&P 500 by 22.7%. And that power bar ratio, which measures future potential, is still very weak. With more bearish than bullish stocks, as a matter of fact, there are zero, count them, zero bullish stocks, 32 bearish or very bearish stocks, which earns this group a ranking of 20 out of the 21 subsectors that we track. Some of the indicative very bearish names within this group: Cosmos Energy, KOS, PDC Energy, PDCE, and Wild Horse Resources, WRD. Let's take a look at one of those names here today, PDC Energy. Very bearish stock, weak trend, weak industry group. So if you're looking for bearish ideas, you're fishing in the right pond. If this name is in your portfolio, you have to question why it is there. Stock closed at $34.25 yesterday, up 4.7%. So some nice outperformance. A lot of these energy names rallying with oil from deeply oversold positions. But here's what I see as I analyze the chart from the bottom up and follow our process. Ribbon at the bottom of the screen tells me we've been bearish or very bearish since August. And since that time frame, PDCE has been underperforming the market. Market and model in agreement. Dynamic duo in gear to the downside. Certainly the type of name we want to be looking at to take a bearish position. Stock is currently overbought with very bearish money flow as this rally here takes the stock back towards the upper volatility bands. I think this is a good opportunity to sell the stock if you own it. Trim or open a bearish position if you do trade to the bearish side. Take a look at PDCE here today. Looking now at yesterday's S&P 500 gainers and losers, I think that we're seeing some counter trend rebounds in the some of the semiconductors. AMD adds 8%. Don't see a lot of reasons why. NKTR, healthcare name that's been very volatile. Remember what I said. JP Morgan Healthcare Conference ongoing this week out in San Francisco. A lot of healthcare companies and investors there. So there could be some commentary coming out of that conference. As a matter of fact, Medtronic over here down 6% yesterday had some cautious comments. Mattel up on some positive news. CMG just catching a bid with consumer discretionary yesterday. Ulta, ULTA, added to the focus list at JP Morgan, sends that stock higher by a little over 6%. PCG down 22% as there is talk of a potential bankruptcy filing there. LW down 6.6%, reversing some of Friday's gains after a beat and raise. Some analysts coming out and questioning whether that was going to be sustainable. As I said, Medtronic, some cautious comments on guidance at the JP Morgan conference. Industry downgrade takes Philip Morris down 3%. No real news to send ICE lower. As kind of turning now to the key themes within my note today. As we said, small caps lead. Here's the IWM, nice bounce similar to the S&P 500, but in a similar fashion as well, taking it towards a resistance zone. RSI does remain in bearish ranges, and we're still in a downtrend on a relative basis. Here's the IWM relative to the SPY. Still in a downtrend, seeing a little bit of a counter trend rally. Nice to see, but feels to me like there's more work to do here, especially with the index below a declining 200-day moving average and a lot of resistance or quote-unquote supply overhead. Again, I think these moves are counter trend in nature. Just wanted to point it out that if you are long some small caps and you've had an opportunity to kind of make back some of these losses, might be an opportunity now to manage some risk and trim some positions. Likewise, defensives lagged on the day. Here's the utilities XLU. Nice breakout, pull back, retest the rising 200-day moving average. The question now is, was this a false breakout and do we head lower? Or does support at the 200-day moving average as well as price-based support in the 50-51 area begin to hold? We have reached an oversold position, which honestly I don't like to see. That could be a sign of a trend change. And on a relative basis, here's XLU against the SPY testing support. Time will tell. I think that if interest rates continue to trend lower, utilities will likely begin to outperform again, as well as if the market turns lower from resistance, I think the defensive properties in the group will play out. But as I said, we are seeing some position squaring, wondering if maybe some new trends are beginning to develop. We're watching them closely as we sit here and get close to inflection points. Technology is at one of those inflection points as well. As a matter of fact, it is breaking support on both an absolute and a relative basis. Let's start with the relative. XLK against the SPY. So tech against the broader market. Again, it's Tuesday. I look at relative trends in my Tuesday notes to Chaikin Analytics members, and we haven't had one of these in a while, just the way the holidays fell. But we are now breaking through support on a relative basis below the 200-day moving average with confirmation from RSI as momentum shifts to bearish ranges. And then if we look on an absolute basis, just as just the XLK by itself, we can see here on a closing basis, it has broken below support, trying to retest it here now. That is bearish as far as I am concerned. Tech appears to be rolling over. Went from leadership to inline to now a laggard, something to keep in mind. And energy is out overbought and nearing resistance. We talked about energy a bit. Here's the XLE. Very bearish Chaikin ETF power gauge rating. Stock has had a nice run here, but still below the long-term trend line. Continues to be an underperformer, is overbought with bearish money flow as it nears resistance in the $62 to $64 area. I think that if you did scoop some energy stocks on the weakness and they've rallied, good opportunity to take some profits in the near term, or maybe look for opportunities to open bearish positions. Concho, CXO, is a name that I'm highlighting in my notes, Chaikin Analytics members today. So that's it. Sign up for the email, chaikinanalytics.com/today. Follow along with this show. Get daily stock ideas for free. I will see you here tomorrow. Same time, same channel. Have a great day, everybody.